students, welcome to lecture 5 of week 8 wherein we have been talking about payment systems in international trade. Today we are going to focus on banking procedures for payment handling. Let us begin the journey. At the outset, we will just go through the contents of today's lecture and discussion. We will start with introduction and discussing the role of banks in trade payments. After that, we will start with key participants and banking channels, followed by stages of bank involvement in export transactions. After this, we will try to discuss handling of advance, collection and letter of credit payments, followed by documentary examination and compliance. Consequently, we will be understanding fund transfer and settlement procedures, followed by FEMA Foreign Exchange Management Act and Reserve Bank of India guidelines for realization. After that, we'll try to understand the relevance of Bank Realization Certificate and EDPMS, followed by bank reconciliation and tracking of export proceeds, and after that we will talk about handling discrepancies and amendments. After that, we will focus on communication between exporters and banks, and the penultimate discussion will be about closure of export bills and pre and post payment actions. Finally, we will conclude our today's lecture. At the very outset, it is very important to understand that banks play a very important role in execution, control, and settlement of international trade payments. International trade payments are the cross border financial transactions and they require involvement of financial institutions across borders. They also include intermediaries such as banks, financial agencies, and regulatory bodies as well. Thus, banks play an integral role in facilitating the foreign exchange transfers in cross border trade. The banks act as trusted intermediaries between exporters and importers whose role is to facilitate the payments in time and within the specified contractual obligations. Banks also ensure documentary compliance, foreign exchange management, and payment security for exporters so that the exporters are not exposed to undue risk and trade facilitation is promoted. Banks do operate under regulatory frameworks such as RBI framework, FEMA Foreign Exchange Management Act, ICC's different frameworks, that is International Chamber of Commerce, different frameworks such as UCPDC, URC, which is Uniform Rules for Collection, URDG, which is Uniform Rules for Demand Guarantee, and other such global banking norms. The benefit of these norms is that disputes do not arise because these norms are transparent and they are used across markets, that is, across countries. Thus, the trust and confidence with respect to application and interpretation of such global rules and regulations facilitate the trade in a better manner. Let us try to understand now the role of banks in international payment system. The first important role is channel of finance. That is, banks provide pre and post shipment credit to exporters so as to facilitate the trade. Banks play this integral role because they understand that pre-shipment and post-shipment are two different stages and the requirement in these two different stages is also different. The second point is related to documentary intermediary. The documentary intermediaries are the banks. They handle letter of credits, documentary collections, bank guarantees, etc. And thus they become very important institutions that are facilitating trade and relationship between exporter and importer. The third role is the compliance authority. The banks has a very integral role in international payment system as they enforce the rules and regulations such as Foreign Exchange Management Act, Foreign Exchange Management Act of 1999, AML, that is anti-money laundering rules and regulations are there, KYC, which is the know your customer norms. All these compliances are followed by banks and thus they become the compliance authority. The fourth role is related to risk controller. It is very important in export and import that risk of the exporter should be mitigated. The risk may be different types: currency risk, default risk, transactions risk, etc. And banks play their important role in minimizing at least two types of risk, that is, the default risk and the currency risk, where banks can play their technical know-how and their vigilance through different documents and procedures that default risk is not transferred to the exporter. Finally, the fifth important role of banks in international payment system is facilitator of settlement. The contractual obligation that arise between exporter and importer in times of trade is very important. It also includes the foreign exchange management, and this particular understanding needs to be properly communicated, and thus it is communicated with banks and they act as the facilitator of such settlements, whether it be the export, import, foreign exchange settlement, converting of the one currency into another currency, remitting of the payment realization, etc. All these are covered and done by banks as the facilitator of settlement. Dear students, let us now move on to key banking participants. The first key banking participant is the issuing bank. The issuing bank opens letter of credit for the importer. The second participant is advising or confirming bank. The role of advising or confirming bank is that they authenticates and guarantees letter of credit for the exporter. The third important key banking participant is the negotiating or collecting bank. The negotiating or collecting bank has an important role to play as they handles documents and payments under letter of credit or collections. Similarly, the fourth key participant is reimbursing bank. These banks have to play the role of settling interbank obligation, that is obligations arising between two banks, say for example bank A and bank B, and they have some arrangement. This is bank A is in India and bank B is in UAE. So these two, the obligation arising between two banks, are known as the interbank obligation in international trade. So reimbursing bank plays this important role. Finally, the fifth are known as the authorized dealer banks. These are the banks that are very important because they are authorized by central banks or regulatory body to handle forex related issues, as well as they also tell about the guarantees, that how guarantees needs to be performed. So they are actually in line with the regulatory bodies or central bank approaches. Let us now try to understand the stages of bank involvement in export payment handling. There are four stages of export and import where the banks play an important role. The first stage is pre-shipment stage. In this, the banks can provide assistance in the form of credit, letter of credit received, and document verification guidance. The second stage is shipment stage. In this stage, we talk about handling of collection or letter of credit documents. The third stage within exports is the post shipment stage, where the most important part of payment realization happens, but also banks play an integral role in forex conversion and reporting of the transactions. Finally, the fourth is the compliance stage, in which the banks are responsible for issuing the BRC, that is Bank Realization Certificate, and updating it in EDPMS systems. Thus, all these stages of export payments are very important, and banks play an integral role in facilitating each and every stage of exports. Dear students, let us now talk about handling advance payments by the banks. Bank verifies the purpose and source of fund under the Foreign Exchange Management Act 1999 regulations. On receipt, foreign currencies credited to exporters EEFC, that is exchange earners foreign currency or current account of the exporter. Then the banks records transactions under the export data processing and monitoring system known as EDPMS. In addition to this, exporters must ship goods within the permitted limit, which is usually 1 year. And finally, handling of the advance payment is also important to link with the post shipment stage. And in the post shipment stage, the post shipment document should match against the inward remittances. Let us now try to understand the banking procedure under documentary collection of URC 522. Under this, the exporter submits document with collection instruction to remitting bank. After this, the remitting bank forwards this to collecting bank abroad. So this involves two banks, one in the home country, another in the destination country. After that, the collecting bank presents documents to importers against the payment, that is DP, or against the acceptance, that is DA. It is on the importer to decide which mode they want to go for. Then, depending on the mode, the funds are transferred through correspondent banking channel, banking channels, and then banks update the realization, that is BRC, Bank Realization Certificates, in the EDPMS system, and that is the final confirmation. Let us now try to explore the banking procedure under letter of credit, that is UCPDC 600. Under this, the exporter ships goods and presents documents to negotiating or confirming bank. The bank examines documents for compliance within 5 banking days. If compliant, the payment is made or accepted as per the letter of credit terms, as well as the issuing bank after this reimburses confirming bank and debits importers. Finally, the transaction is recorded under Foreign Exchange Management Act 1999, and letter of credit documents are archived, that is they are recorded, that is they are kept in record keeping so as to be used in the future course of actions. Dear students, let us now try to focus on documentary examination and compliance. The banks verify documents only on face value, that is not on goods. Checkpoints include consistency of description, value and shipment dates. It also includes validity and expiry of letter of credit or the documentary collection terms. The examination and compliance also includes the verification of certifications, signatures as well as stamps. Any discrepancy must be notified promptly to exporter for rectification within a specified time limit. Let us now try to explore the payment settlement and fund transfer mechanism. The payment settlements are routed through international payment systems such as SWIFT, that is Society for Worldwide Interbank Financial Telecommunication, RTGS NEFT for domestic leg transfers, and Nostro Vostro accounts, which is between banks for foreign currency exchange. The Nostro and Vostro accounts are used When two banks, one from one country and another for another country, builds up a relationship related to export and imports. The payment, settlement, and fund transfer mechanism in export and import are very interesting and important. In this, the proceeds should be credited to exporter's account in freely convertible currency. In with respect to India, the conversion of the recipient, that is payments, to Indian national rupee are governed by a Reserve Bank of India's exchange control rates. Let us now try to explore the FEMA, that is Foreign Exchange Management Act, and Reserve Bank of India's guidelines for payment realization. According to both the guidelines, export proceeds must be realized within 9 months from shipment. That is specifically mentioned under Foreign Exchange Management Act 1999. Delays beyond this period, that is 9 months, requires Reserve Bank of India's approval. Thus, this is a separate approval. An exporter should try to settle things within 9 months, otherwise, there may be more delay because of extra scrutiny and vigilance. In addition to this, all remittances must be linked with the shipping bills in EDPMS systems. It is the responsibility of the banks to ensure export compliance with the help of export declaration form number 1, number 2, the GR form submission for physical exports, and number 3, regulatory reporting through AD, that banks, that is the authorized dealers banks. Dear students, let us now try to see the export documentation flow through banks. The exporter submits invoice, packing list, and transport documents. The bank has important role. The bank checks consistency and forwards for negotiation and collection. The third, importer's bank, also has an important role to play. It receives and processes for payment. Then the payment is credited through interbank network, that is two banks are involved, one bank in home country, another bank in the destination country. After that, there is involvement of exporters bank, wherein the exporter bank issues the bank realization certificate after the confirmation of the realization. Finally, all these stages ensures traceability and regulatory transparency across different stages of exports. Let us now talk about the bank realization certificate. The bank realization certificate is the official proof of export payment realization issued by the authorized dealer banks. These are mandatory for claiming different incentives offered by DGFT in India, that is Directorate General of Foreign Trade, as well as for claiming the goods and service tax refunds. Also, it is generated electronically via eBRC, that is e-bank realization certificate module, which is integrated with the DGFT portal. The eBRC or the bank realization certificate contains details such as shipping bill, realized value of the goods, date of supply, and the currency which is being used. Finally, it is important for all of us to appreciate and understand the fact that BRC, that is Bank Realization Certificate, ensures linkage between trade performance and foreign exchange earnings. Let us now try to focus on export data processing and monitoring system, that is EDPMS. It is a Reserve Bank of India mandated platform integrating customs and banking data. In addition to this, it tracks each export shipment till payment is realized. Not only this, it flags overdue on unrealized bills for compliance action. The EDPMS system enables automation of bank realization certificate issuance and reporting for Reserve Bank of India. Thus, EDPMS, that is Export Data Processing and Monitoring System, forms the backbone of India's export payment monitoring ecosystem. Let us now try to understand the bank reconciliation and tracking of export proceeds. Banks often maintain export bill registers, which can be e-registers also, to track each shipment's payment realization. Every transaction is linked to shipping bill number and EDF form, that is export declaration form. Reconciliation by bank ensures that payment received equals invoice and letter of credit or collection value. Second thing, that bank reconciliation also ensures that currency has been converted at official setting rate. Finally, it also ensures timely update in EDPMS system and timely generation of the bank realization certificate. Let us now try to understand the handling of discrepancies and amendment requests. Discrepancies do arise in these types of payment mechanism. They generally and commonly arise in documents, values, or timings. The bank role in such scenarios is to identify the discrepancy within 5 banking days as per the UC PDC 600. And within those days, they have to notify the exporter, and if it is applicable, the foreign bank or importer should also be notified. The banks has an important role to play to assist exporter in submitting corrected or substitute documents if required. Also, it is important to seek importers' waiver of discrepancy when possible, which reduces and improves the trust in the international trade. Let us now try to understand the communication between exporter and banks. Communication occurs through authenticated and traceable channels such as SWIFT, which is MT7 series for letter of credits and amendments, email and e-advice for domestic coordination, courier scan transmission for document dispatch. The exporter's responsibility lies in two things: to promptly submit shipping documents and to clarify queries that are raised by bank within the allowed time frame. Let us now try to deeply understand the closure of export bills and post-payment actions. Once payment is realized, the authorized dealer banks will perform the following function. The first, they will verify inward remittance details with EDPMS entry. The second, they will close corresponding export bill in the system because the transaction has completed. Third, they will issue EBRC, that is Electronic Bank Realization Certificate, to exporter for claiming incentive and for record keeping. The fourth is there will be archival of original documents for minimum 5 years, which is as per Reserve Bank of India norms, that is record keeping of the documents will be for 5 years. Let us move on and see that what happens in case of unpaid bills. In case of unpaid or partly paid bills, they are tracked for writing off. That is considered to be a loss, or they can also be treated for extension or final settlement under the Foreign Exchange Management Act guidelines. Thus, we can see that completion of all these steps marks final closure of payment handling in the banking cycle. Dear students, let us now conclude whatever we have discussed in today's session. We have discussed and highlighted that banks are central facilitators in the movement, verification and realization of international trade payments. Also, their procedures ensures accuracy, compliance and accountability from shipment to fund settlement. Not only this, we have also learned that integration of documentary controls, Reserve Bank of India guidelines, digital systems such as EDPMS, EBRC, and SWIFT has enhanced efficiency and transparency in export import trade. We have also learned that timely coordination between exporters, banks, regulators ensures smooth realization of export proceeds. Not only this, we have also learned that mastery of banking procedures is essential for maintaining financial discipline, trade credibility, and sustainable export growth. Dear students, with this we have completed today's lecture. Thank you very much for being with me in this session.